everybody. Thanks for being in the moment with the Everness Home Group. I am Kinsey Moberg.
I'm Ken Willits.
I'm Whitney Jester.
And we're here today with Jennifer Sims from SWBC. Hi, Jennifer.
Hey, thank you for having me.
Absolutely. Today we want to talk a little bit about what is happening in the real estate market because it's gotten a little bit crazy out there with interest rates right now, wouldn't you say?
Yes.
Okay. So tell me what you're seeing. Where are rates right now in general for people?
Yes, rates right now, you could say they're right at 7%. Okay. When you talk about an interest rate, there's a lot of different factors, points, discount points, buying down the rate. You have to be really careful when you look at published rates online. But when you talk about just kind of the base rate, where we're at right now, 7%. And of course that has credit qualifiers and all that stuff.
Okay, so 7% right now. Where was it like earlier in the year when people are thinking there's still an adjustment period in their mind? They're thinking rates might be lower. Earlier this year, they were where?
They were in the low threes.
Low threes, okay.
I remember December, January, there started to be discussion of, it's really going to happen. Rates are going to go up, but none of us expected what we saw this year.
Yes, and I'm also reading some people are projecting it could hit as high as 9 by the end of this year. Are you seeing that too?
I do not think it would go to 9.
Okay.
That would be crazy. I mean, well, it's been crazy, so maybe, but I think we'll see a little bit more increase. I don't anticipate it getting to 9.
Okay.
One thing that is important about that is home affordability is getting more and more challenging. So, yes, hopefully. I mean, we only have 2 months left. And so what happens with mortgage rates is they typically precede the Fed rate in anticipation for that Fed rate coming up. So we've got another increase. So I don't think we'll get to 9s, but it's going to be higher than where we're at right now probably.
Yeah. Okay, so let's switch gears a little bit and talk about what people can be doing to prepare. Let's say life has changed and you're really in a place where you need to buy a house right now. It is actually a pretty good time because some of the prices are stabilizing a little bit for a lot of people, and I know that there are some down payment assistance programs that Ken has researched a little bit, was talking with you earlier about. Ken, what were you finding? What have you been looking into, and what questions did you have for Jen about that?
Well, I guess because of the interest rate being high, the buyers are concerned about they can't qualify for that much more of a house. So they're looking at ways to qualify. And one of them was a down payment assistance. I was talking to a client just last night, and they mentioned the program T-Shack. So I wanted to get Jennifer's opinion about that program.
Yes. T-Shack is one of my favorite down payment assistance programs in Texas.
What does that stand for people who are new?
Yes, Texas State Affordable Housing Corporation. There's a couple different ones in Texas, but that one is the most generous with income limits. You really can be right at 100,000, a little over 100,000 gross income to qualify still. So that's pretty generous for a down payment assistance program. Those programs have had their own responses to what's going on in the market. And so I was telling Ken earlier that not all the programs are available that are usually available with T-Shack right now. But we still have options, especially FHA and conventional. There are a few options for assistance.
Okay.
Yeah, and that assistance can go towards down payment or closing costs. There's a lot of flexibility. Yeah. But we really want to be watching not just the asset portion, which is what a down payment assistance program really helps, is getting you to the table. But now with rates going up, it's what is my monthly payment and can I afford this price of home?
Yeah.
So there's a lot of different factors. So when we're talking about what do buyers need to be doing to prepare, honestly, they just need to talk to a mortgage lender. The second you think, especially if you're a first-time home buyer, I think we might be ready, get with a mortgage lender. You don't know what you don't know. Right? Because that's what we're going to look at. We're looking at, do we need assistance just to get the down payment? Are there options that don't require a down payment? And then what are we looking at with debt to income ratios?
Yeah.
A big piece.
So there's some down payment assistance programs, but I also know that as SWBC, you have a Buydown program.
Yes.
Talk a little bit about what that option would be if buyers explore that, what that would look like in the transaction.
So there are several different ways you can actually buy down your rate. The traditional way is to pay discount points to buy down your rate for the whole term. So let's say you're doing a 30-year fixed rate mortgage. You'd pay X number of dollars to get from a 7 to a 6.5.
And that's a discount point.
That's
just being simple for people who might not be familiar.
Yes, a discount point, that's the cost to get a lower rate.
Okay.
That's the traditional way. 2-1 temporary buy downs are becoming very popular right now because you kind of have to be in like a perfect environment for that buy down to make sense, and we happen to be in just the right real estate environment for it. So what it is, it's 2-1 buy down. So you still get your fixed rate mortgage. That's the big number one thing to remember, is that this is not an adjustable rate mortgage.
Okay.
Those can be popular in high rate environments too, because sometimes you think, who wants to lock in a 7% for 30 years?
Right.
Like, no one wants that. But you don't always have to go to an ARM. An adjustable rate mortgage, you get, at year 5 or whatever year it adjusts, you have to get a solution, or you are subject to what's going on at that point in time. So what's nice about the 2-1 buy down is that you get a 30-year fixed rate mortgage, and your note rate is 7%. We'll just say that. The 2-1 part is that in year 1, you are 2 whole percentage points down. So
Wow.
in year 1, my interest rate is 5%.
Wow.
In year 2, my interest rate is 6%. And then in year 3 and on, it's at 7%, which is where it would be normally. So, on like a $300,000 loan amount, that's saving, like, in your first year, it's probably like almost $400,000 a month off your principal and interest. That's how much interest rate impacts the monthly payment. So in the 2-1 buy down, the reason it makes sense is because rates are high right now. Right. Most people believe that in the next year or 2, rates are coming down. And 3, we are in a buyer's market. So the other important thing about temporary buy downs is that there is a cost, right? Because I was saying in a normal buy down, you have to pay points to buy that rate down. 2-1 buy downs have a rule that the buyer cannot pay the points. So the lender, seller, or builder have to pay. And in most cases, the seller is going to give seller concessions to pay for that buy down. So in a seller's market, it doesn't work. Because remember, just a year ago, sellers didn't have to do anything.
Right.
So 2-1 buy down would not have been a likely program that would, a buyer would do, because they wouldn't be able to get it done.
Right.
We're just in the perfect storm for it right now. If I was buying a home, I would be doing that program.
So what is the cost?
There's a calculation for it. So it's, I'm trying to think, the one I just closed, I think it's going to be based on the loan amount. They were like around $250,000 loan amount, and I think the cost was around $5,000. So it's
2 points?
It's not as
It's not that simple, huh?
Yeah, it's not as straightforward as that. But it's all within that seller concessions. You know how every loan type has a different amount of seller concessions?
Yes.
We still have to abide by those rules. But really what's interesting is that, so the seller's contributing, let's just call it $5,000 to this buy down. The buy down right lasts for 24 months, and it's really, that money actually goes into an escrow account. It's kind of interesting how it works. It's not a normal buy down. That money goes into like this little holding account, and then the lender contributes every month to buy the rate down for the buyer. Now let's say that buyer refinances. Okay, so in all of our dream world, next year we're in the 4s, again, and everyone's getting out of these, higher rate options. So they've only had their loan for 12 months and they want to refinance. There's going to be money left over in that account, and what's really neat is that it will be deducted from their payoff. It is really their money to go towards buying down that rate for 24 months.
That's awesome.
So it's a really unique program.
That's great. So it's a way to have the facade of an adjustable rate without the shock at the end of when the rate changes.
It's without the risk.
Right.
Because then the other thing, maybe our dreams don't come true. We're not at 4% next year. Maybe we keep going up for a while.
Right. But then you're still at 7 instead of at 9. Or some people are saying Fannie Mae is projecting maybe 11.75 by the end of next year. However, Mortgage Bankers of America is saving 5.6. And so I vote for them.
I vote for them too.
I vote for them to be in charge next year. Actually, I don't want anybody in charge. But Anyway, so let's say it trends higher instead of going lower, then you're still locked in at 7 as opposed to 9 or higher.
That's right.
So you do have options right now for buyers. They have options going in. They have T-Shack, which is down payment assistance options. They have the 2-1 Buydown program. They have adjustable rate mortgage if they need to. And if they're working towards something in their life and they know that they're on the upswing over the coming years, and they could maybe invest in an ARM if they have to and then look to refinance. Either way, people are going to be looking to refinance in a few years,
yes,
ideally.
It would be challenging for our market with home values to continue to have rising interest rates because of just affordability.
Right.
And that's a big initiative government-wise,
Yes.
too, is housing affordability in America. So all those things will come into play, which kind of provides me a little comfort that there will be a stop. There will be a
Right.
So what's happening right now is there is an initiative to reduce inflation, and that's why we're going through what we're going through.
Right.
This is planned. There's someone behind it making, it all happen.
It's orchestrated.
It is orchestrated, and so this is not our fate forever.
Right.
We are trying to accomplish a goal economically,
Right.
and we're kind of,
Yeah, we're just along for the ride at this point. Okay, so let's go early into the process. Let's say you're a brand new home buyer. They're a first time home buyer, and you're like, all right, we have kids on the way. We are priced out of the rental market. We have some savings. Walk us through the process from the lender's perspective of what the buyer needs to expect, where credit needs to be. Like, give us the really quick synopsis of what a new home buyer can anticipate from the lender's perspective.
Right, so lenders look at 3 different categories. We look at credit, income, and assets. It really boils down to those 3 things. So credit-wise, lenders will say, oh, we will go down to 580 credit score for an FHA loan. Doesn't that sound nice?
In theory.
In theory, all mortgage loans have to approve in what's called an automated underwriting system. So if you're a 580, it doesn't mean you get a loan.
Right.
Right? You don't just get a loan. All different factors have to make that file say, even though they're at 580, this is still something the investor wants.
Right.
You've got a lot of assets or something like that. So compensating factors. So
right.
Technically you can get on to 580. You want to shoot, I think 620 is a real safe place to say that's just a good place to shoot for if you're new, you don't have a lot of credit. Again, 740 plus is really the prime interest rates, best loan options. That's where you want to be. But if you're not there, it doesn't mean you can't buy a home. Okay, so really you want a 620. I just think that's a safe credit score to shoot for if you're just getting started. No matter where you're at, it's a good time to have a lender pull your credit. You may not know what you don't know is on there, honestly.
Right.
One question that buyers always ask is, if they pull my credit, does that affect my credit score going down?
Yeah, everybody asks that.
Everybody asks that, and any legitimate lender is going to do a hard credit pull, which people tend to be very afraid of that phrase. But you have to do a hard credit pull if you're going to get a mortgage loan. Anyone that says, oh, I'll just do a soft credit pull up front and give you a pre-qualification, run the opposite direction. That's
not helping you get the house.
And you miss things on a soft credit pull. So, yes, your credit score adjusts a little bit when you have a hard inquiry.
But there is a time limit on that too. You can have 3 pulls within 2 weeks and it won't dig more, right?
That's right.
So it allows you to shop rates.
That's right. And so the way the credit bureaus work is they categorize who's doing the credit pull. So if you have multiple lenders pull within that certain period of time, it's going to essentially be effectively as one pull. And we're not talking 20 points down. And there's not a 1 or 2 points. Actually, credit is very complex.
Yeah.
All the algorithms that go into it. If you're a person that goes car shopping every week, you've had a lot of inquiries in the last 12 months, and when you have another hard inquiry, you're going to feel it.
Yeah.
Right? If you're a person that's protective of your credit report, you do not need to be concerned about a mortgage lender pulling your credit.
Right.
So that's a great question.
Yeah.
They all ask it.
They all,
do.
every
Yes.
time, yeah.
Yeah.
I mean, and it's a legitimate concern
Sure.
for those who are right on the line. Say you're trying to get to a 620 and you're worried that, or you're right at 620 and you're worried that a hard pull will drop you down, and then maybe it delays the purchase a couple months while you're trying to build it back up. So it really depends on where you are
Yes.
within that range.
Yes.
So,
Well, and to that point, you do not need to wait to get pre-qualified. I know everyone wants to be, let's just look at homes for a while first. Let's just, get a feel for the market.
that's a
Okay.
recipe for disaster,
What if-
by the way.
What if you find the home you want? I mean, this happens all the time.
It does.
It happens all the time, and the lender gets the call at night. Oh, we found the home. We've never gotten pre-qualified before. Okay, do the loan application. Wow, you've got this going on. We're missing this,
Yeah.
and you can't buy the home yet.
Yeah,
but let's get you on a path. So why did you
Right.
wait so long? What was that fear?
Yeah.
Get over it.
It's going in blind.
It is. It is.
So I have a question about the interest rates. So a lot of my clients are saying, well, I'm just going to wait till the interest rates go down and then we'll start searching for a home.
Yes.
And I tell them, well, they're probably going to go up before they go back down because
Yes.
they're so used to the 3% or the 2%. So they're a little bit scared to make that leap.
So a good thing to remind people is that when we had the 2s and 3s, those were actually artificially
Yes, they were. Low.
artificially low. Again, that's not a healthy economic environment. That was because of COVID, and then government buying mortgage-backed securities to kind of help us out. Like, refinance to a lower interest rate, get a lower payment. Okay, we're not going to see those again for a while. And the other thing I'd say to people that say, I'll just wait for them to go down, I'd say, oh, well, what data are you reading that says when they're going to go down?
Right.
I mean, because everything I read actually is a little bit different. And as wise as these financial experts are and economic experts are, they don't know either.
Right. Everybody
We really
is
don't
speculating.
know. And so, the people that have bought many homes in their life, they're the ones that are actually most relaxed about this.
Yeah.
Because what they know is that they've refinanced many times.
Yeah.
Right.
And it's the home. We always date the rate, but, marry the home, date the rate. It is so true.
Right.
Let's just focus on getting in the home. It's I'm very passionate about first-time home buyers right now. You do not need to be spending money on rent ever. If you want to sell and buy and wait a little bit, that's fine. You're already in a home. Wait till spring, see what happens. But probably what's going to happen is there's going to be an acceptance of where rates are at.
And then everybody's going to flood the market again, and then you have more competition.
Yeah.
And I was actually listening. Dave Ramsey had said the other day that because of where people are right now, because of the hesitance and the lower competition that's happening right now, and the fact that rates are eventually going to go down, like this actually is, given what's happening with prices at the moment, this is the best time to buy a
great
home
time.
in the next 5 years.
Yes.
I mean, if you have cash, that's awesome, because then you're getting in on the lower prices without having to worry about the rates. But for those that even are having to be subject to the rates, you have options. You have ways to work around what's happening right now to your benefit to get the home that you want, that you can afford to get equity into, and then know that you're paying a fair price for it and that prices are still actually going up. They're still trending up, even though there's been a stabilization. Over time, they're trending up, so there's still equity to be had. And it's a solid investment now, even with rates as they are, even with them rising. And
That's
so timing is good. Did you have something? Okay.
Sorry.
Anyway.
I think we were talking about what buyers should be doing right now in preparation. So we talked about credit.
Yeah.
Income's the next item to be aware of. Employment and income. What is your 2-year history? Is it stable? There's all sorts of things we can talk about. Again, talk to a mortgage lender. They will be able to tell you right away if you're on track or not. But income is important. A stable income. There's all different ways to look at stability and commission earning, bonus, all the different earning types. So that's credit, income, assets. How much money do you have in the bank? Are you needing to have reserves, extra money for your loan file to approve? It is not cut and dry. So many people think, oh, I need 620 and I can get this loan. it's actually not that simple.
Right.
You know, and so there's many different factors to look at. Credit profile is a huge one too. What is making up your score? You know, maybe you've got a 700 but 2 late pays on your current mortgage in the last 12 months. That's not great. You know, we may have to address that on certain loan types.
Yeah.
So those are the 3 areas that a new buyer needs to be aware of, and it's not something to navigate on your own.
Right.
It's really not. Like, if I were to go buy a car, I would never like just start researching about the engine and this and that. I don't have enough base knowledge to really know and get a good feel for what I need to prepare for in buying a car. This is me. I would go to someone I trust that knows everything about cars.
Right.
And that's how I'd make my decisions and set up my plan. So it's the same thing. It's just kind of accepting, like, I don't know what I don't know. I just need to find someone I can trust to get me on the right path.
Right. Right. Have you ever done loans for people who don't have credit scores?
Yes.
Okay. How often do you come across that? Because there are people who are increasingly saying that's not a system I want to be a part of.
Right.
So talk to me about what that looks like from the lender's perspective.
So it's called non-traditional credit loans, and we prove their credit worthiness in other ways.
Okay.
So we are not depending on the credit bureaus to formulate a score. We are depending on 12 months of rent history on time, no lates, 12 months of...
I have a question about that.
Yes.
Does their landlords report rental payments to somebody? How would somebody prove that they pay their rent on time?
We do a verification of rent.
With their landlord? Okay, gotcha. All right.
Yes, or they could produce like 12 months of canceled checks, and we'd see that they're on time. There's a couple different ways to do it.
I have a client.
Yeah.
Yeah.
The wheels are moving.
Yeah.
Wow.
And depending on the situation, there's going to be a couple, you know, maybe 2 to 3 other credit trade lines, we call them, that we'd want to look at. It could be a Netflix account. It could be a water bill. It could be a cell phone bill. But we need 12 months on time. No, you know, no lates. Because that's really what credit is.
Yeah.
I can make a payment on time month after month after month.
I just heard that binge watching can help you buy a house.
Yes, that's what I was saying. Moral of the story.
All of your habits add up. Okay,
Yeah.
awesome.
I still don't recommend it, honestly.
Right.
I think there's a really safe way to utilize credit to your advantage. But again, you have to be able to trust yourself.
Right. Yeah.
But if you are just morally opposed to credit, there are other options.
Okay, good. Okay, so let's switch gears for a quick second and talk about from the seller's perspective right now, because the market is definitely shaken up. There's still a lot of equity to be had in the homes, especially people who have owned their homes 2 years or more right now. Should they go to sell, what they're seeing right now is buyers are not making offers at list price at the moment. There are some homes that if they're well priced and in great condition and just ready to go, there still are multiple offer situations happening in this area. There is still competition. But more and more across the board, I'm seeing that the buyers are testing the waters more. And so Whitney's like, sure, yes, that's what's happening. So from a seller's perspective, what can sellers expect from a lender in the transaction? How often do you reach out to the seller side, or what should they be looking for and expecting through a transaction?
Through a transaction. So the mortgage lender is really working for the buyer.
Yes.
And the buyer's agent.
Yes.
So that's important to remember. I do like to give the listing agent an update here and there. It will be more about timeline and how, we're on track. And I share about the appraisal to the buyer's agent typically.
Okay.
You guys can share that, the home met value.
Right.
So that's kind of how a mortgage lender would interact with the seller.
But the sellers can't anticipate just getting the appraisal outright.
That's right. That's
Right.
correct. Yeah.
Right.
you do want to be careful as a seller still to make sure that you're seeing the pre-qualification letter.
Yes.
You also, and this would be a good seller's agent, this is your responsibility when you're listing a home. When was that letter written? Rates were much lower 3 months ago even than they are today. And technically a pre-qualification can last for 4 months because that's how long a credit report lasts for.
Right.
So we need to be seeing, okay, is that interest rate in line? Because what if the lender hasn't looked at that account again and we're up another 1.5 points?
Right.
That could impact their qualification. So you really want to, be aware of that, and then local's always best. We've got so many good local lenders in Waco. The reason it's important is because there's massive accountability between the lender and the real estate agents, and just access to great appraisers is another thing that local lenders have typically a better track record with than some online lender from New York. They maybe have a much smaller panel of appraisers that they'll use. So all things to think about.
Yeah, and the different points of contact you can end up looped into with the larger lenders, and closing gets delayed. And I also would advocate local lenders whenever possible. It really does make a difference. Okay, any other thoughts or questions at this stage?
Well, on your point about sellers, the one other thing I would say as advice is listen to your real estate agent for your list price. I know sellers are having a hard time because there are comparable sales in the last 6 months that say, I should be able to sell my home for this.
Yeah.
And your real estate agent, you guys know this, knows the truth of where we're at right now. And, that starting list price is so important for how quickly, what your goals are, how quickly you want to move your home.
Yeah.
So again, I think kind of a common theme today is you have to get with trusted advisors on all sides of buying a home. Yeah.
There are areas right now in our market where you look back at the comps and the average sale price for a comp will be $20,000 higher than the current list price and what's on the market right now, which is indicative of the shift where things have closed much higher than they're actually selling for right now. And that is the shift in that area. And so the good news for sellers is they likely have had the house more than the last couple years to be able to absorb that kind of balance or reconciliation as far as equity is concerned. So it's not putting people in much of a pinch necessarily, depending on their personal, issues. And but there has been a balancing in that way. And so having an agent that is watching those things and seeing and able to pinpoint that's what the shift is, this is what's happening here, and then making sure we're in that range when it comes to listing. There are areas where it's more drastic right now, and sellers still do have the mentality of, this is even this summer, even 3-5 months ago, 6 months ago, and it is very different. And so we just need to make sure that we're, staying on top of it and communicating. But the good news is that the homes are appraising right now. Easily, because we've got really strong 6 months. It's the opposite than we had a year and a half ago when we were all, I hope the home appraises, because everyone's willing to buy $30,000, $40,000 over asking in Little Waco, and I sure hope there's a comp to support it. So we don't have that problem right now. We just there's a lot of great history for good values. Yeah, that's good. Awesome. Well, let's go ahead and wrap it up on a high note. Thank you so much, Jennifer Sams with SWBC Mortgage here in Waco. We have Whitney Jester and Ken Willits, and I am Kinsey Moberg here. We are with the Everness Home Group in Waco, where we help people find the space that resonates. Thank you so much for being in the moment with us.